Welcome to Celebrity Investing. This is part 2 of the ultimate guide to dividend growth stocks for long-term investors. Criteria for selecting dividend growth stocks. Picking the right dividend growth stocks can feel overwhelming, especially with so many options available. However, by focusing on a few key criteria, you can simplify the process and make smarter investment decisions. Below, we'll explore the fundamental metrics and factors to consider for identifying the strongest candidates for your portfolio. Payout ratio and growth consistency. A company's payout ratio and its history of dividend growth are fundamental metrics when evaluating dividend growth stocks. The payout ratio represents the percentage of earnings paid out as dividends. Ideally, you want a balance here, not too high and not too low. Why does this matter? A very high payout ratio, for example, above 75 to 80%, might signal that a company is overextending itself and could struggle to sustain its dividend during economic downturns. On the flip side, an unusually low payout ratio could mean the company isn't prioritizing shareholder returns. Look for companies with a payout ratio under 60%. This leaves room for dividend increases even if earnings take a temporary hit. Next, consider dividend growth consistency. Companies with a long history of reliably increasing their dividends, 10, 15, or even 25 consecutive years, are often more stable and shareholder-focused. These long-term growth patterns demonstrate that management prioritizes disciplined financial practices, even in tough market conditions. Check out lists like the Dividend Aristocrats or Dividend Kings for companies with decades of increases under their belt. Remember, stable and growing dividends reflect strong fundamentals. A consistent track record isn't just reassuring, it indicates the company's confidence in generating reliable cash flow. Earnings growth and stability. Dividends are paid from earnings, so without strong and predictable earnings, dividend growth will eventually hit a wall. When analyzing companies, focus on those with steady earnings growth and minimal volatility. Companies with rising earnings over several years are in a better position to sustain and grow dividends. Look for earnings per share (EPS) growth. A good rule of thumb is to aim for mid-single-digit to high single-digit EPS growth annually. It's also important to check how consistent those earnings are. Some companies, like utilities or consumer staples, have predictable revenue streams because they sell essential products or services. Compare that to businesses exposed to cyclical industries, like oil and gas, where earnings can swing dramatically. Ask yourself, does this company have a reliable product or service? A diversified, strong revenue base often signals stability, reducing the risk of dividend cuts. Lastly, don't forget forward-looking indicators. Dig into quarterly earnings reports to see if management offers optimistic yet realistic guidance. Growth that's not supported by earnings is like building a house on sand, it won't last. Industry and competitive position. The strength and position of the company's industry can make or break its ability to deliver long-term dividend growth. Certain sectors, like healthcare and consumer goods, are ideal hunting grounds for dividend growth stocks because they tend to generate reliable demand. Conversely, highly cyclical or rapidly changing industries, think tech startups or travel, might not offer the same consistency. Beyond just the industry, pay attention to the company's competitive advantages. These include factors like market leadership. Does the company dominate its sector or niche? Being a market leader often means greater pricing power and steady profits. Economic moats. Consider whether the firm has durable advantages, like patents, strong branding, or cost efficiencies, that outlast its competitors. A wide economic moat acts as a protective barrier against threats, helping ensure steady cash flow for years to come. Debt levels versus peers. Excessively leveraged companies can struggle when interest rates rise or the economy slows. Compare debt-to-equity ratios to evaluate financial health. A strong position in a resilient, Stable industry is often a sign that the company can withstand headwinds while continuing to increase dividends. For example, companies like Procter & Gamble and Johnson & Johnson thrive in sectors that serve everyday consumer needs, giving them the consistency to keep rewarding shareholders without interruptions. By digging into these factors, you'll build a clearer picture of which dividend growth stocks can withstand uncertainty while continuing to grow shareholder returns. Use these criteria as your guide to find reliable performers for the long haul. Top dividend growth stocks to consider in 2023. Dividend growth investing is all about identifying companies that not only pay dividends but consistently increase them year after year. These firms tend to have strong business models, reliable cash flows, and shareholder-friendly management teams. For 2023, let's explore top contenders across sectors that have shown resilience and commitment to rewarding shareholders. Tech sector highlights. While tech isn't the first sector investors associate with dividends, the landscape has shifted significantly. Several leading technology companies are now dividend powerhouses, blending growth potential with reliable payouts. These businesses often combine innovation with strong financial fundamentals, enabling them to consistently grow dividends. Microsoft, MSFD. Known for its dominance in software and cloud computing, Microsoft has increased its dividend for over a decade. Its payout growth is supported by robust free cash flow driven by platforms like Azure and its enterprise solutions. Apple, AAPL. Apple remains a cash-generating machine thanks to its ecosystem of products and services. With consistent dividend hikes since 2012, it demonstrates a commitment to returning value to shareholders while investing in future growth. Texas Instruments, TXN. A standout in the semiconductor industry, Texas Instruments focuses on long lifecycle markets. Its dividend growth rate of over 10% annually, paired with manageable debt levels, makes it a favorite among dividend-focused investors. These tech companies are examples of how innovation and shareholder returns can go hand in hand. As technology integrates further into daily life, their dividends are likely to remain robust. Consumer staples and utilities. Stability and consistency often define the consumer staples and utilities sectors, making them go-to options for those seeking reliable dividend growers. These companies tend to operate in industries with steady demand, regardless of economic conditions. Procter & Gamble, PG. A dividend king with over 65 years of annual dividend increases, P&G remains a staple in many portfolios. Its diverse product lineup, including household names like Tide and Gillette, ensures steady cash flow even during economic slowdowns. Coca-Cola, KO. Few companies rival Coca-Cola's brand power and global presence. A pioneer in strong dividend growth, it has increased payouts for more than 60 consecutive years, driven by its dominance within the beverage market. NextEra Energy, NEE. As a leader in renewable energy, NextEra Energy shows that utilities can be both growth-oriented and dividend-focused. Its regular dividend hikes are supported by consistent revenue from traditional and green energy sources. These companies thrive in sectors essential to daily life, providing the kind of dependability dividend growth investors seek. Emerging opportunities. While established names dominate the dividend growth conversation, it's also worth considering up-and-coming opportunities. Some sectors and companies may not have decades of dividend growth behind them yet, but they show potential thanks to strong earnings and strategy. Brookfield Infrastructure Partners, BIP. Focused on global infrastructure like utilities, transport, and data centers, BIP has been ramping up its dividend to reflect growing cash flows. Its position in an expanding sector holds promise for future increases. Amgen, AMGN. As healthcare spending grows, Amgen, a leader in biotechnology and pharmaceuticals, has steadily increased its dividend for more than a decade. Its commitment to innovation and a pipeline of treatments could drive future cash flow growth. Realty Income, O. Known as the monthly dividend company, Realty Income operates in the resilient real estate sector. Focused on retail properties with long-term leases from creditworthy tenants, its reliable payout increases make it a compelling pick. These emerging dividend growers represent industries with strong future potential while already signaling shareholder commitment through regular increases. By diversifying across established leaders and high-potential newcomers, investors can build a portfolio that balances current stability with future growth. Keep an eye on these companies as part of your dividend strategy for 2023 and beyond. Tips for building a dividend growth portfolio. Building a dividend growth portfolio requires more than just picking stocks that consistently raise payouts. It's about creating a balanced, reliable strategy that positions you for long-term success. Below are key components to consider as you shape your portfolio, offering practical advice for maximizing returns while mitigating risks. Diversification across sectors. Relying too heavily on a single sector is like putting all your eggs in one basket. It increases vulnerability to market swings within that industry. Diversifying your investments across different sectors is essential to reduce risk while ensuring steady income streams. Think of sectors as different streams feeding a river. While one stream may run dry during a drought, others may surge. For example, consumer staples and utilities typically provide stability during economic slowdowns, whereas sectors like technology or industrials might shine during periods of growth. A well-diversified portfolio balances these dynamics. Consider aiming for representation across sectors such as consumer staples, for example, Procter & Gamble, for consistent demand. Healthcare, for example, Johnson & Johnson, for its resilience during all market cycles. Utilities, for example, NextEra Energy, for predictable cash flow. Technology, for example, Microsoft, for growth potential paired with solid dividends. Financials, for example, JP Morgan Chase, for exposure to the banking sector's reliable dividends. Mixing established dividend growers with companies in faster-growing sectors creates a dynamic and balanced portfolio. Reinvestment strategy. While dividends are great for income, reinvesting them can amplify their impact. By automatically reinvesting dividends into additional shares of your dividend stocks, you can leverage the power of compounding to accelerate your portfolio's growth. Some brokerage platforms offer dividend reinvestment plans, DRIPs, which make this process seamless. Reinvesting dividends allows your portfolio to grow faster, and since dividends are often paid quarterly or annually, you'll have regular opportunities to put your dividends to work. Patience and long-term focus. Dividend growth investing is not about chasing short-term gains. It's about focusing on steady, predictable income that grows over time. Be patient, and don't be swayed by market volatility. Stick to your strategy, and over the long run, your portfolio will compound and provide increasing payouts. Remember that the power of dividend growth is not in the immediate payout but in the long-term compounding effect. The sooner you begin, the more time you have to let dividends grow, reinvest, and accumulate. By holding for the long haul, you'll unlock the true potential of dividend growth investing. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.